So good day, family. I am here, or this interview is finally here, the long-awaited interview with the prominent loan officer, Demond Johnson. First of all, I appreciate you guys being here with us. You could have been anywhere in the world, but you're here with us. I definitely appreciate that. I received a good number of questions from everyone who had an interest in the loan process and things like that. So I have those questions here, and then I will ask them and then get you guys your answers. But I wanted to introduce, this is Demond Johnson. As I stated before, he has 17 plus years in the game and is very knowledgeable in the lending industry. So without further ado, this is Demond Johnson. Could you please give us give us a little bit about yourself? Give us that long resume of all those great things that you've done already.
We'll try to keep that short for them. I want to bore them. But again, my name is Demond Johnson. I've been in the business now for about 18 years, and I am the president of Gentech Mortgage Corporation here in Dallas. Originally from Detroit, moved here from Chicago. Been in Dallas since 2012, and I'm also a finance instructor for the Texas Real Estate Commission. I teach finance, real estate finance, at the largest school in Texas, which is called Champions School of Real Estate. A lot of agents, that's where they got their education from. So just excited to be able to talk to you guys and answer any questions or concerns about lending. There's a lot of myths when it comes to lending, credit, income, all the things that we look for. So hopefully I can solve some of those problems or issues that people have out there.
Great, because I'm definitely looking forward to it. First of all, I want to say thank you for taking the time out of your busy schedule to sit with me and answer these questions. I have my notebook as well. I hope you guys have your notebook and you're taking notes and you learned something. If you missed something or a question is not asked that you guys wanted to know, hit me up later. I can definitely get in contact with Demond and we can get you that answer. But without further ado, in no particular order, these questions, I just took them and I wrote them down. So first question is, what is the average interest rate right now?
Average rate we're seeing right now, obviously the rate depends on type of program, depends on FICO score and such, but typically I would say under 3%. We're seeing 30-year rates, 2.875, 2.75. Depends on the program. I've got some rates that we've locked for some clients on VA deals at down to 2.375.
Oh wow!
It just really depends on a couple of different things. I mean, we even have some rates that we locked at 1.999. Which is kind of nuts. But obviously, that to get down here, you're paying a bit more in closing costs and to buy your rate down to do that, and to determine whether or not that's necessary really kind of depends on how long you plan on being into the home. So you want to be there long enough so where that lower payment, you're there long enough to recoup the benefit of it. So for somebody who's hey, I'm buying this house and I'm not going anywhere for the next 10, 15 years, it might make more sense for them to spend a bit extra money on the front end to save it on the back end. Gotcha. But if it's hey, I'm going to be here, and I know we might be here for about 3 years, may not make as much sense financially to pay a lot of money up front to it's not going to be there long enough to even break even. But we're seeing rates in the twos.
Nice. So, but basically, what I'm hearing in your answer was basically it's not just about the interest rate of the loan. There's more that encompasses what you're looking for when you're out there searching for a loan.
Yeah, I mean it's if you're working with a experienced lender, they'll ask questions. They'll ask questions of the buyer. One of the main questions I always ask is how long you plan on living in the house. Without knowing that, I mean, it's hard to determine how to structure somebody's financing. So that's a big question. I don't think it gets answered enough. I think what happens is typical consumer just says, hey, you know what? I'm shopping for the lowest rate.
Right.
Whoever can give me the lowest rate is going to win my business. Sometimes the lowest rate is not always the best deal.
Right.
So
Exactly.
you have to look at closing costs and all the other factors. So it's just a matter of it's consulting over, I call it consulting versus order taking.
Okay.
You
Gotcha.
can't just punch in, in a computer and take orders like you're at Burger King. You have to ask people some qualifying questions to determine what might be better for them.
Gotcha. That's why I definitely appreciate Damon and his ability, his passion, his attention to dive into the consumer to make sure they're getting the right deal. But okay, great. The next question that I have is, what's the lowest down payment you can put for a conventional loan, and then a VA loan, and then an FHA loan?
Gotcha. Okay, so we'll go through we'll do VA first. So veterans qualify with no money down. Okay.
Gotcha.
In majority of the cases, I would say in 98% of the cases, but there are some loan limits that we have to follow. So if they want to buy a house that's above that particular loan limit, they may have to bring some money down. But in general, as long as the loan is within $510,400, that or lower, then there's no money to bring down.
Nice.
They still pay closing costs.
Right.
Okay, so a lot of veterans think that that's not the case.
Exactly.
I won't go into detail as to kind of why they think that, because that's a separate question, but
Gotcha.
they do pay closing costs. Sometimes those closing costs are being offset by the seller giving them a credit, and so that there's an impression that, well, I didn't have to pay closing costs. Well, you did.
Yeah.
It just was built into the purchase price, or it's kind of rolled into the financing somehow, but you still paid it. The other one is for FHA, you can put as little as 3.5% down. What I like for clients are really conventional loans. On a conventional loan, you can put as little as 3% down. Most people either hear 5%, and so I can do FHA because FHA is 3.5 and that's lower, so I'll go the FHA route. You can get a conventional loan with 3% down. You don't have to be a first-time home buyer necessarily either. But the sweet spot, I think, is a conventional loan with 5% down. So it depends on which direction to go. Kind of depends on FICO score sometimes. But I really prefer more conventional loans for a couple reasons. The FHA charges a 1.75% upfront mortgage insurance premium that gets rolled into the financing. That doesn't apply on conventional loans. Also, when it comes to the monthly PMI that you pay, FHA loans, you're going to pay PMI for the life of the loan, versus on a conventional loan, at some point when you reach your equity position reaches 20%, then you can request to have the PMI removed, and so ultimately it can be cheaper in the long term. So in order to get out of the PMI on an FHA loan, you have to refinance out of the FHA loan into a conventional loan, which then costs you more money. So it's 0% down in VA, 3.5% FHA, and as little as 3% down on conventional.
See what I mean? This is the type of, you're in the market and you're looking for a loan. I promise you, I would have to recommend Damon to you, because he's not just looking at the money aspect. He's more concerned about the consumer. You, the consumer, trying to get that loan. What's best for you? So anyway, I'll get off my marketing. The third question is, what does my credit score have to be to obtain a loan?
It's a complicated question sometimes.
Yes, it's a loaded question there.
The market has sort of changed where, we used to see some programs that allow, 580 as a minimum score. Ever since COVID started, a lot of banks have tightened down on their requirements, and we're seeing typically the minimum requirements that most lenders of ours will want to see is about a 640. You can do it as little as a 620 in some cases too, but it may just be a bit more expensive. So I think I'm not a big believer in buying a house with low credit scores, even if the bank will accept it. Part of the reason why is a lot of consumers are so focused on, I think that the two of the most dangerous words in financing to me are "you're approved." To me, I think those two are the most dangerous words. People are so focused on being approved, and they're not focused on the terms in which they were approved.
Right.
So great, someone did your loan with a 600, credit score. What were the terms? What did it cost you? What was the interest rate?
Exactly.
That's gonna be, so yeah, it got you into the house, but if your interest rate is a point higher, 1.5 higher than the typical interest rate that you could have gotten had your credit score been a bit higher, then you're gonna pay for that in the long term.
Exactly.
And companies will tell you, oh, don't worry about that, you'll just be able to refinance later on. None of us, we don't have crystal balls. I can't dictate what rates will be in the future. I can't dictate if your score is ever going to go up in the future and how soon. So whatever financing that you get when you buy your house, you have to assume that, hey, I might be stuck with this for as long as I own a home, and are you okay with that? And if not, you might want to hold off, get your affairs in order. I kind of feel like if you have a 580 credit score or a 600 credit score, my first question is why? Why do you have that? Why isn't your credit score 740? Why not? And so let's analyze your credit and see what's going on. Are you making late payments? If you are, why?
Right.
Why are you making late payments? If you're making late payments, how does adding another large debt, like a mortgage payment every month, how is that going to, make the situation better? Are your scores low because your credit card utilization is really high? Well, that's kind of an issue too. How do what's your plan on being able to pay that debt down in order to get those scores up? If you don't have a budget in place, you have a budget in mind. So I think there's this rush to like, I need to buy a house, I need to buy a house today, instead of asking or people in our industry, asking, are you prepared? Because, a lot of times we make it so easy to get into the house, but then we don't make it easy to remain in the home.
Exactly.
You can buy a house and, what happens is if the air conditioning goes out in the middle of July, 3 months after you close, then what? You don't have any money saved, you have very little credit. What are you going to do? That means you got that means that HVAC company says, okay, great, we'll give you the funds, we'll give you a loan. It's going to be double-digit interest rates. They're going to charge you $2,000 more than what it normally would cost you. And what are you going to do? You don't have a choice. It's 110 degrees in your house.
Exactly.
So I think the mentality that I have is more not just getting somebody in the house today, but thinking long term, how to set you up for success, for 5 years, 10 years on the line. How to make sure that the mortgage is just one aspect of your financing. You still have student loans, you still have credit cards, you still have other things.
Right.
And so it's kind of important to let's look at your entire financial picture versus let's just see what the minimum I need from you in order for me to make a commission.
Exactly.
That's missing the point. So, my opinion.
Anyway. I 100% agree and appreciate you for that, because for you guys out there's a lot of loan officers out there, or lending companies out there that don't take you under consideration as far as once they make that deal with you, now you're in the house and all you can eat is peanut butter and jelly sandwiches and things like that. They're not concerned about that. So
those are good though.
Those are good. PB&Js are good.
That's not knock a good PB&J, right?
Well, I definitely appreciate your passion and concern for the customer. The next question I have is, should I purchase now or should I wait till after the election? So I guess basically, how does politics affect the lending industry and things like that? Or is there an effect?
It's really hard to say. I mean, I think when you have a change in power, then that sort of, not disrupts is the wrong word for it, but it could have an impact on the economy, because the you have economists that have anticipation of, okay, well, this type of candidate here might be a bit, more stringent,
Right.
in their policies. This client right here might be a bit more open in their policies, and so sometimes there's an immediate reaction of just anticipating before that individual has even stepped into the White House or signed any bills or anything, just
Right.
kind of an anticipation of it.
Right.
And it's a lot of times it ends up being kind of a wait and see. You get there, all of a sudden there's a reaction, like, oh, okay, well, that wasn't as bad as we thought it was. It really wasn't nothing. And all of a sudden the market kind of comes back down. It's hard to dictate, whether or not somebody should buy a house now or wait. Rates are good right now,
Yeah.
and so I think what we don't know is we don't really know I don't think we know the full impact of what COVID will have upon the economy.
Gotcha.
And I think that's pretty much, if I was to have any type of hesitation, I would be more concerned with that in a sense. But the real estate market will always have its ups and downs. It always bounces back. And so right now the market is strong. And so it's just really, I'm more concerned with people are they prepared? Are you prepared to buy a house? Are you financially prepared, mentally prepared? Is your credit in order, your assets in order, and you have reserves? Okay, you have some money saved up, that's great. Is the money saved up once we take your down payment, we take your closing costs from you, are you down to $10 in your savings account?
Right.
That's not a good idea, you know what I'm saying? So I want to make sure that people they prepared for it. They just didn't wake up on a Saturday and say, hey, I want to be a homeowner tomorrow. It's something that they thought about 6 months before, a year before, and they've been making preparations, putting things in place to make sure that they can be a successful homeowner. So my focus is normally really there, because that's what you have control over, but you don't have control over the market or who's in the White House, or it's just nobody really knows.
Right.
Which is
Okay.
so I wish I did know that. I'd be a billionaire.
Yeah, I know.
I could predict.
That's fair enough.
Yeah.
So basically, people out there, just focus on your situation and make sure that you're in the right position to purchase a home, as opposed to focusing on the politics and what's going to happen in the next 90 days, et cetera, et cetera. So great answer. So let's see. The next one is: are there any exceptions to the required debt to income ratio? If you could, in your answer, could you talk a little bit about that front and back ratio, and then are there any exceptions to those?
Yeah. First off, not really much exceptions to it. You can either afford it or you can't.
Right.
Okay. How you get around debt to income is you either pay debt off, not get into debt in the first place, or find a way to make some more money.
Exactly.
So the debt to income is basically a ratio of the income that you make on a monthly basis, your gross monthly income, in relation to the monthly debts that you're responsible for. And those debts people are kind of confused on what things that we count. We normally count the things that would apply, that would show up on a credit report.
Gotcha.
Car payments, student loans, credit card payments, those type of things. And there's also a few things that don't show up on credit reports often. Let's say someone has a kid and they have a court order to pay child support.
Gotcha.
So you have to count that. If you went to a divorce and maybe you're on the hook to pay alimony, you have to count that. So court orders also play a part in things that we have. And traditionally, that's maybe about 3% of the time that we're seeing that. It's usually car payments,
Gotcha.
credit card payments, student loans. The key thing to kind of keep in mind is people have always heard, hey, don't go out and buy a car before you buy a house.
Right.
Okay. Because if you got to go out and buy a car, you got a $600 payment. We're going to basically take that, and add it to our calculations, and then whatever's left over is what you have for a house. It's very easy to go get a car after you got your house.
Yeah.
Any car dealership, for the most part, got a good credit score, they're going to give you a loan. It's not a big deal.
Gotcha.
They're not taking into account debt to income as much as we are as a mortgage lender. So in essence, really how it works is, just for easy numbers, let's say someone makes $120,000 a year, or let's just say someone makes $60,000 a year. Okay, $60,000 a year divided by 12 is $5,000.
Gotcha.
Okay, and that $5,000, that's your gross income. Obviously, when you get paid, you don't see the full $5,000 every paycheck. You got taxes that come out and other deductions that come out. So what we typically allow somebody to use is, let's say on average, let's say we allow them to use 45% of that number.
Okay.
For the sake of the recording, we'll just say, let's say we allow them to use 50% of that number, just to kind of make it really simple on paper. So now, 50% of that number would be $2,500. Okay. So what that means is that within that $2,500, your monthly debts and your new home purchase, your new home payment, all have to fit within that $2,500.
Gotcha.
So that $2,500, so the first thing we do is go to credit report and we start subtracting things. Okay, you got $2,500 here. Oh, look, you got a nice new car.
Take that away.
Good for you. That's $700 a month.
Right.
Now we're down to $1,800.
Okay.
Okay, you've got some credit card bills. We don't care what the balances are. All we care about is the payments. So let's say you got $200 in credit card payments total. So now we're down to $1,500.
Yeah.
No, $1,700. We're down to $1,600. Okay, let's say you've got some student loans. Student loans might be $200 a month. Okay, now we're down to $1,400.
Yeah.
That $1,400 represents your buying power.
Gotcha.
So that represents your $1,400 is the maximum mortgage payment that you can have, and that mortgage payment is including property taxes, your homeowner's insurance. If you're paying PMI because you put less than 20% down, it's counting that. If you buy into an area that has an HOA, we count the 8 monthly HOA fee. So all of that has to fit within that money that's left over.
Wow.
So if you can imagine, so that's the idea of, if you didn't have the car payment, now instead of you limit at $1,400, we can add $700 back.
Exactly.
So now you have about $2,100 in buying power. So a big difference when you're looking for a home of what can I afford. A $1,400 max payment is a very different house than a $2,100 max payment. So that's really kind of debt to income and how we calculate it. My advice to my clients is to not look at things from what is the maximum that the bank will approve me for, more looking at it from what am I comfortable paying.
Gotcha.
Because maybe you make a good income and you got little debt, and I say, hey, you can afford a mortgage payment up to $4,000 a month.
Right.
Okay, well, is that what you want though?
Right.
Exactly. And so it's important to look at it from the standpoint of what am I comfortable paying? What is comfortable for me? Because you're the one who has to make the mortgage payment, not you or I.
Right.
So what are you comfortable paying? And then let's make sure that is within what you qualify for.
Gotcha.
And then somebody might say, well, I'm comfortable paying $900, but then you want to have me in a house.
Yeah.
So also it has to be reasonable. You know what I'm saying? So, but yeah, I like to start there so that, people that are buying, they don't bite off more than they can chew, just because on paper we tell them they can afford to get them into that house. Because remember, we're using your gross income. You still have to, we're not counting your auto insurance, we're not counting your grocery bills, we're not counting daycare for the kids, we're not counting private school, we're not counting a lot of other things that you're responsible and typically in paying, and so only you know those things.
Right.
And so your debt to income from a mortgage standpoint might be, let's say 30%, but in real life, once you say add on those other things that we're not asking you about, your debt to income can be a lot higher, and only you know that. But I try to ask clients, hey, what other things did you spend your money on you're responsible for, to get an idea, to make sure you get a house for it. So you can still afford to do all the things that you want to do.
Yeah, that's those peanut butter jelly sandwiches.
Yep.
Okay. So You heard the advice. If you're in the market to purchase a home, don't go buy a new car right now when you can get that new car after you purchase the home as well. So, and then make sure you're in. Well, if you work with Damon, he'll absolutely make sure you're in the right position to purchase a home at this time. So.
One more thing before you notice that.
Yes.
Damon is also probably going to tell you not to go out and buy that new car after you bought your house.
Yeah.
I'm going to be the one who talks you out of that. And so that's another big problem. Mm-hmm. Sometimes people they're financially conservative. They're making all the right moves in order to put themselves in a position to buy the house. And then once they get approved for the house and closing the house, then it just goes out the window. Yeah. I got a brand new house. Yeah. I need a brand new car to go with my brand new house. I got a brand new house, got a brand new car. Oh, I need brand new furniture now to go to the house. So then they go to Nebraska Furniture Mart or somewhere else. Yeah. They get approved on the spot for a $15,000 limit. Don't worry, no payments, no interest for the first year, whatever it is. Blah 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 blah. You tell yourself in your mind, oh, I got a whole year. Oh, I'll have that paid off in a year. Yeah. I always tell clients. Go back to the credit cards that you have right now. How long have those balances existed on those credit cards?
Talk to them. Yes.
Have you ever had a credit card you paid off in a year? Mm-hmm. No. So what makes you think that you're going to max out this credit card at $15,000 and pay it off before the interest kicks in? You're not. You're just telling yourself that because mentally you want to feel comfortable going out and maxing out this credit card and putting all this new furniture in your house. Because you can't wait for your housewarming, you can't wait for people to come over and be like, oh my God, look at how great your house is. Right. Who cares? Get your house. If you need to sleep on a air mattress for the first couple months because you're saving up money to do it. Who cares what people think? I could care less what. If I come in, hey, do I have a place for you to sit? Yes, there's a chair right there. Have a seat. Right. I don't need a $4,000 sectional and an 85-inch TV to impress those that come see me. The majority of people that care about us, they don't care they're just happy, man. Congratulations, you bought your house. Mm-hmm. They're fine with that. They're not concerned with what's in your house, how it's decorated. I'd rather you buy things as you get money as you go along than to put yourself in debt right away and find yourself in a bad situation. So that's my mentality, and hopefully, man, people really, listen to that.
Thank you for that. Needed that. We definitely needed that. Let's see. Next one is: are there any options for closing costs for those who don't have a lot of money saved? That's one of the questions there.
Yeah. I mean, I know the first solution that a lot of people are told to do is to go get down payment assistance. Okay. I don't really believe in it too much. In a sense, in some cases yes, in a lot of cases no. But I don't believe that should be a person's first option choice. I look at it like more as to me, down payment assistance is more this. I've been saving. I put myself on a strict budget. Man, we don't do this anymore. We've really done everything we need to do. And we're now this short. Mm-hmm. We're really close. We're this short now. And I need some assistance. Right. Okay? In my opinion, that's what down payment assistance was supposed to be. It's like if you and I are running a race, right? And I've got a half mile to go. Mm-hmm. You're like, man, Damon, I'm trying to help you. I'm gonna give you a little push. Yeah. Give you a little bit of assistance. Yeah. Okay. That's a different story. I've already ran majority of the race. I just need a little help with the last little bit. Yeah. But if I haven't even started running yet, and you're trying to drag me from the beginning, from the circle, then that's not what it's for. So I mean, it should be hey, I've already done as much as I possibly can on my own, and I could just use a little nudge. Yeah. That's what it should be. Instead, it's turned into this. I've been saving a dime. I've been budgeted, and I don't plan on it. I'm just going to get this money
Right.
because somebody has told me that it's free and it's not free.
Right.
I don't care if they call it a grant, whatever they call it, that's just a fancy word. It's not free. Typically what's happening is this is the rate that you qualify for. So those rates that we're talking about, you asked me earlier, 2.75, 2.875,
Mm.
you're not getting that with down payment assistance. You're going to pay probably a point higher than that or more, to get that. So you're paying it over time in extra interest when you could have saved up your own money, set yourself up for long-term success anyway, and got yourself a lower rate, which might have saved you $80,000, $90,000 in interest on your loan over time.
Exactly.
And so it's just it's not something I normally try to offer to my clients. Like I say, unless it's just a little bit of a nudge that they're looking for, but then I explain to them that, hey, this is not free. This is what it's really costing you, and this is what it's costing you long term. You still want to do this. A cheaper way to do this really is, so let's say you're planning on making an offer on a property, and you're making an offer. Okay, I think we're going to make an offer for $250.
Okay.
But you're running the comparables in the market, and you notice that, hey, you know what? I think this house could easily appraise for $260 based on what other properties have sold for in this area recently. And so what you may do is, instead of offering $250, you say, hey, I'm going to offer, closing costs are estimated, let's say about $7,000. I'm going to offer $257.
Okay.
And then just request that the seller rebate back the buyer the $7,000.
Yeah.
That is the cheapest, easiest way to have your closing costs paid, because you just basically build into the financing, into your purchase price.
Okay.
And now we don't have to tinker with your interest rate.
Right.
Interest rate's still the same.
Gotcha.
And so that's a cheaper way to be able to go about it, and it doesn't have the financial impact that it has if you increase the rate in order to get money back. So that's typically what I recommend, and for some reason a lot of agents don't do that. They just go right to recommending down payment assistance, and it's like,
yeah.
and I have to think about it sometimes, and why is that? It's because, well, they're not making a payment.
Right.
Who's the interest rate impacts? Doesn't impact me, doesn't impact you, it impacts the buyer.
Yeah.
And so, to me, I don't think it's always a responsible thing to do. And it's just for everyone's a little bit different. So to me, it's client by client. Once I look at their finances, we have a conversation, then we determine whether or not, hey, is that the deal what you need to do? Or is it this, that you need to actually save up some more money and, you need to start budgeting. Right. So, just depends on client by client, but it's kind of hard to answer that question and give like a blanket answer because